Any moment now, the Fed will announce the decision on the future of interest rates, all signs pointing to no change this time around, holding rates steady as the Fed awaits further data on inflation and jobs. President Trump's policies also a factor when deciding whether to cut borrowing costs again. The Fed saying it needs to assess the economic impact. Let's bring in our ABC News business correspondent, Alexis Christoforous, along with our Elizabeth Schulze. She also covers business and the White House for us. All right, Alexis, I understand the numbers are just coming in. You're kind of going through it. So are you, Elizabeth? Maybe we start with just big picture, and what are you seeing so far?
Well, this is the Fed's first decision of the new Trump administration, and after three interest rate cuts in a row, we're expecting the Fed to take a bit of a breather as they take this sort of wait-and-see attitude. They want to wait and see what these Trump policies, namely tariffs and taxes, tax cuts, will mean for the overall economy and inflation. Remember, the Fed wants inflation to be down to 2%. It's been moving closer to 3%. And so most believe the Fed will not only hold steady on rates today, but could hold steady for months to come, which means if you were hoping for lower rates on things like mortgages and credit cards, you're going to have to wait a little longer.
All right. I understand, Elizabeth, you have your hands on it now. What do we know?
Yeah, Kira, as expected, the Federal Reserve did keep its interest rates unchanged. The Fed leaving rates steady where they are in this decision. Its first decision of the Trump administration, first decision of 2025. Notably, one change in what the Fed releases its statement when it looks at kind of the big picture of the economy is that it says inflation remains somewhat elevated. So a little bit of a nod there, Kira, to the reality that the Fed is saying our main priority over the past 2.5 years, 3 years, has been bringing inflation down. They say they've made remarkable progress, but some of that progress has stalled a little bit. And now in its formal communications, the Fed is saying inflation is still somewhat elevated. So now what we're going to be looking at really closely is what the Fed chair, Jerome Powell, will speak in about 30 minutes, what he says about those risks from inflation, from the Trump administration's policies, as Alexis was saying, but also just any headwinds to the economy, which on paper looks really strong, but underlying questions about if there are reasons why it's taking a little bit longer than the Fed maybe had hoped to bring those prices down, Kira.
All right, got it. So, Alexis, give us a reality check here. Are those prices going to come down, and will they come down soon?
Well, you heard Elizabeth just mention what the Fed said in their statement. The Fed's feeling a lot less confident about inflation coming down the way they had hoped, which means that it's going to be most likely higher rates for longer. So if you look at the interest rate situation right now, I mean, you have mortgage rates near 7% once again. We still have credit card rates. They've come down a little bit, but they're still hanging out near record highs of about 20%. Even car loans are elevated. A 5-year car loan now around 8%. I guess the one good news is you're making a little more money on your money because as these rates remain elevated, you're getting better returns on your money in the bank. So if you have a savings account, money market account, CD, things like that. But most economists believe the Fed's going to take this wait-and-see attitude, and we could get possibly 2 rate cuts later in the year, if any at all, as we wait to see what these Trump policies mean for the economy as they work their way through the economy and what happens with inflation. I mean, in the coming days, we're going to learn more. We're going to have a jobs report out on Friday and then new inflation data later this month. But the Fed is expected to remain data dependent, as they always say they are.
All right. Got it. And Elizabeth, you know, how do you think these high interest rates could be a positive, you know, with those with money in a savings account?
Yeah, we talk a lot about, Kira, about the higher borrowing costs when you're thinking about taking out a loan for a new home or a car. But there are some upsides to these higher rates, especially for people who are saving money. So when you think about the point of higher interest rates, it's basically to incentivize people to put more money in the bank. Right now, you can earn still pretty good returns on your money in the bank. So think of a high-yield savings account. Those rates are about 4 to 5% returns right now. That's pretty good if you're just leaving that money sitting there. The idea is that the Fed really doesn't want people to be out spending aggressively because it sees the economy on solid footing. One of the questions we're going to be looking at really closely is what does the jobs market look like, Kira? You know, we've talked a little bit about a slowdown in hiring, but it has been pretty resilient. Going to listen really closely to what the Fed chair says about companies' plans for hiring as they ramp up in the new year here.
All right. Stay tuned. Elizabeth Schulze, Alexis Christoforous, thank you, ladies.